Hi and welcome to Optimum TV. I'm Stephen Adams and welcome to a latest edition of our Dealmakers series where we talk to the movers and shakers in life science investment. Today I'm joined by Jonathan Tobin, who's a partner at Brandon Capital. Hi Jonathan.
Hello Stephen.
Thanks for being with us. Let's jump straight in and talk about Trump's tariffs or his threat of tariffs. What impact is it having on life science investment at the moment?
It's certainly added another level of unpredictability into a market that's already been quite cautious. On the positive note, I would say in the UK and Europe, we're a little bit less affected than our American parts. And the same is true, or even more true, in our base in Australia, which is a little bit less of a feast and famine environment than it is in the US.
Okay, so for those unfamiliar with Brandon Capital, which as you said is Australia-based, tell us a bit about the firm, its background, what it invests in, its investment approach, as well as your particular role at the company.
Brandon Capital was founded in 2007. We've raised 6 funds, over $1 billion under management. Our last fund was raised last year, was $270 million. And we really focus on first-in-class therapeutics. We do a lot of company creation, seed, Series A. About half of our funds are deployed in Australia, where we have a unique collaboration of all of Australia's medical research institutes. And the other half is global, particularly UK and Europe. And we also have an office in San Francisco and a few of our portfolio companies in the US as well.
Okay, and your particular role?
So I am building our portfolio out in Europe. We now have 8 companies here, 6 of which in the UK. We have one in Germany, one in Switzerland. And then in addition to that, helping our European companies establish clinical trials and collaborations in Australia, which is an excellent place for doing clinical research. And likewise, helping the Australian companies with syndicating investment rounds, hiring management, meeting pharma and creating networks in Europe. So there's a sort of two-way synergy there.
Okay, great. Let's talk about the investment climate over the last 5 years or so. There was obviously a huge investment boom in biotech in the COVID years, but that came to something of a halt in 2002, and there's been a bit of a dearth of cash since then. What implications has that had for biotechs, which obviously still need money in the last couple of years?
Yeah, I'd say until very recently, we were sort of back to the pre-pandemic rate of investment, which was pretty sensible. So neither feast nor famine. And a number of our companies actually refinanced in a very effective way last year, and so now have runway through 27 and 28, which puts them in a very solid position. I think for companies that need to raise money now and that can't sort of weather the current storm, it is tricky. We are able to support our companies ourselves a bit longer, and I know that other investors are doing the same. That naturally means a little bit less dry powder for new deals, and we are looking at new deals. We've already made 3 or 4 new investments this year, and we'll do a couple more. But I do think it raises the bar in terms of the quality threshold needed to sort of trigger a de novo investment when we've got lots of hungry mouths to feed already.
Okay, and what about for VC companies as well? Money doesn't grow on trees. You've got to raise funds too. How does it affect your operations and your approach?
In the short to medium term, it doesn't affect it. You know, we're quite fortunate we have committed capital, they're long-term funds. You know, investors can't just redeem their cash because there's some instability in the market. And that's really important because we do a lot of early stage company creation. It takes many years to grow these things. And so we have to be resilient across market cycles. Obviously, our LPs, which are large, mostly Australian pension funds, are not unaffected by the global macro situation. But, you know, in terms of the fundamentals, nothing's changed in our industry. there's still a demand for breakthrough medicines for serious diseases. And at the end of the day, having positive clinical data, efficacy and safety data in phase 2 trials is what drives the value. And ultimately, our portfolio companies will get acquired if they produce important drugs, that have been de-risked. And we've been successful in the past providing sort of pipeline assets for pharma. And we've got at least a dozen companies that will have clinical catalysts over this year and next year. And a few of those will probably drive to an outcome. And, for example, this week we've had one company that had an FDA approval for its cardiovascular device. We've got companies that have successfully raised large funding rounds, even very recently. And so I think for good quality companies, there is still a very successful path forward, especially if they're private at the moment.
Okay, that's good to hear. Now I'm going to ask you that impossible question. Do you think the investment climate will be better, worse, or no real change come this time next year, which I appreciate is not a very long time frame?
That is a difficult question. I will probably say it will be a little bit better than it is right now, as in today, because we are in a very sort of short-term shock from the impact of Trump and the tariffs and the great deal of uncertainty. I'd say there's probably been a bit of an overreaction.
Mm-hmm.
I think in a year's time, there'll be a bit more certainty about what's happening with the FDA and the regulatory approval process. I don't think it's in anyone's interest to make that process unfavorable for the industry. So I would say it will probably be a little bit better, but I would say that the bar for very high quality companies will still be very high. I would say that the Chinese industry will continue to produce very high quality molecules that are more like fast followers. And, from Brandon Capital's perspective, that's okay because we're focused on sort of first in class innovation anyway. I think it does make it more difficult if you're not doing something that's highly differentiated. But at the end of the day, venture capital really is there to fund the creation of differentiated assets. So I think that will just be the case as well next year. And I think longer term, over the sort of 3 to 5 year period, we will swing back into growth for the sector, especially as the loss of exclusivity issue that pharma's facing in the sort of 27 to 30 window starts to get resolved, and they start to refill their pipelines with earlier innovative assets again.
That's great. Thank you very much indeed for your thoughts, Jonathan Tobin of Brandon Capital.
Thanks.
Are you watching Optimum TV? In our bite-sized episodes, we talk to European life science leaders about the hottest trends, innovations and capital market developments in the sector. To subscribe, visit @OptimumComms on YouTube. You can also watch all available episodes on our website, optimumcomms.com.